welcome Richard Sandor here at Kellogg. Richard is a pioneer of financial innovation. I'm going to say a few words that many of you probably already know, but in case you don't, I think it's important that we kick off this with a little bit of short bio, and then we kick into questions. So he's a person that I really admire because of his ability to make contributions both in academia and outside of academia. And as an academic, I really feel that they're pretty close. So Richard got his PhD in economics in University of Minnesota. Then he started his career at Berkeley in a period that I think was very interesting to be at Berkeley. And then moved to Chicago. And he knows Kellogg quite well because he was teaching a class on, first class, I think, on futures and options here at the Kellogg School of Business. And the reason why Richard was in Chicago, if I remember correctly from the book, is that you were already sort of helping the Chicago Board of Trade to design the first interest rate future contracts that started trading in 1975. And so many of you would probably know him as the father of future contracts. These are contracts on intangible products. So really, that's the main innovation, I think, right, relative to futures on tangible things that we had for a long time, but we didn't have futures on intangible assets. I was actually teaching risk management like 15 minutes ago. Some of my students are here in the class, and I think those students and all of you probably appreciate the importance of that in terms of changing the way institutions and corporations manage risk and sort of modern financial market functions in general. But his influence on financial markets hasn't stopped at interest rate futures and futures and options, but he has been applying this creative thinking also to a major, maybe the main challenge of our time, which is climate change. And that's the story we want to talk about today, which is the story of a company, the story of a startup that became a large corporation, the Chicago Climate Exchange, which is the company that basically created the market for carbon trading, for emission trading in the US. And as I said, this is the story of Richard as a founder, as a entrepreneur, and that sort of, I think it would be a lot of interest to students to know your experience in that sense. So the book we're going to talk about today is Carbon Hunters. This is the book, but we want to make this closer to a case study, to a lecture class, as close as possible. So welcome, Richard. Let's get started with some questions.
Thank you for the very kind introduction. It's really great to be here because so many of the things that I've been the privilege of being part of began in this campus when I was a visiting scholar in '72 and have tried out over the years almost every major new invention. I'm an economist who invents markets. I get it wrong a lot, but once in a while I get it right. And so Kellogg's been a great incubator for those ideas. And every time I did have a new idea like financial futures, I test drove it here in '74, carbon markets, I test drove it here in '06. My grants were here, and Don Jacobs, whose name is scattered around this campus, was a mentor and friend. So
great.
Thank you all. It's great to be here with you.
Fantastic. So I actually want to start from the story of the idea, and then we talk about the story of how you put in practice the idea, right? So this idea of carbon trading, like when did it came, and where did it came from, and when did you decide to put your energy and your time into this?
It actually started with acid rain. In the late 80s, I got a call from a person who produced limestone. Limestone is used to suck sulfur out of flue gases, and there was a bill before Congress to stop acid rain. And the limestone group asked if I would write a paper about the potential for acid rain allowances, the right to emit. They were going to put a cap on the emissions, and then if you went below the cap, you could sell your excess reductions to somebody else. It was just a way to drive reductions to the least cost source. I gave the paper. I worked the bill in Congress because I knew how to do that from financial futures, creating the CFTC. I marched the halls. I advocated it, joined the Acid Rain Advisory Committee. There were some key things that the academics and NGOs they did a great job, but they missed some of the financial engineering, like QSIP numbers for emissions, registry designs, all of the things that all of you are learning here about capital markets. It was at the EPA. I get a call. Somebody said, you commoditized interest rates. You seem to have commoditized, acid rain, and the program's been fantastically successful. For $3 billion in costs a year, it throws off $150 billion annual health care reduction costs. And in the 80s, well before your time, they made movies about acid rain, Michael Douglas and Black Rain. It was just a horrific problem, and it was solved and gone. So UN said, come to Geneva. You think you could commoditize a global pollutant as opposed to a local pollutant? I said, sure. Got on a plane and flew to Geneva, and they said, we're having this Earth Summit in 1992. Would you write a paper about it? I was part of an NGO group of environmentalists. I gave the paper and finished the talk, got a caparina on the beaches of Rio, and I said, I think I know how to do this. I think that they're talking about things that are not coherent. What you really need to do is put a price on carbon, like you have a price for corn or wheat, and that's going to incentivize the growth. It's going to incentivize inventive activity. And I said, we have to focus on pricing carbon. And once you price carbon and reduce the amount of emissions, a market-based solution is very simple. It's David Ricardo, the gains from trade.
Although, I mean, as you know much better than anybody else in this room, creating these markets takes a lot of time, right? Like, there's a lot of steps that have to fall into place. And so I think it would be very interesting to sort of reconstruct, now that we know the origin of the ideas, like how do actually you went and implemented in practice. And, your story as a founder, I imagine, goes through the same steps as many other founders. You got to raise capital, convince the right people, think about regulation. So it would be great, I think, also for the student to know your experience, starting from like raising capital, for example.
Sure.
You raise capital for this. And I know Kellogg has a role to play in this.
Yeah,
so that's a little bit of
we'll go through that, and it'll be a fun story, and I think a story you could use in all of your career. So the first thing is starting a new business and inventing a market. Let's start off with the premise. It's an art, not a science, okay? And you look for macro trends, okay? So I think there's a killing curve if everybody has a slide. The first one. So if you look at the beginning, and I looked at this in 92, and I said, oh my God, this is a trend. And I had been trading commodities, and I said, I think this trend could go on. So there's the basis for it, and it starts with that idea. You go and you advance, and you run into a person who has a foundation in Chicago. The UN asks you to speak in Glen Cove, Long Island. You run into somebody who worked for Jacques Cousteau, and my co-author who wrote the Calypso, 1,000 miles into the interior Amazon. She's this high and that much power by raised to the nth. So she's a dynamic woman from the Bronx. And I say, hey, I think the way to deal with this is to start the market. And theorizing is all fine. She said, nobody else listens. I say that to the panel. The diplomats are looking at me like I'm from the Central Bank of Mars, okay? And they have no idea what I'm saying. Fast forward, she gets a job here in Chicago running the Joyce Foundation. Now, I had been consulting. I did a trade for the first SO2 allowances. I bought my company, not I, Environmental Financial Products, its predecessor, bought Costa Rican rainforest credits in '95. So we began to worry about things, about how do you guarantee against mudslides. There's no satellite imaging at that point, and how do you have radar overflows to measure carbon that is in trees that is growing. You have a lot of technical things to grade the commodity, just like in 1850, how do you grade protein in corn? You know, you measure how yellow it is, right? So you got very imprecise standards for commoditizing it.
And if you can grade it, probably you can trade it.
That's precisely. If you can grade it, you can trade it. And so Paula comes to town, and Kyoto had passed. I spent a lot of time traveling the country in academic institutions, the White House, gone to Kyoto. I'm all in now, and I want to get a business going. And Paula comes to town, and she calls up and said, remember me from the UN? I'm president of a foundation. I like the idea, love the idea that you said we should trade it. So she said, I'm going to go and try to get a new type of grant. And she said, how much money do you need? And I said, what's the scope of what you want to do? She said, let's do a feasibility study. We're in the upper Midwest, so we'll take the industrial states surrounding the Great Lakes. It's about a $2 billion economy. It's country size. And we'll look at the feasibility of a regional market in greenhouse gas in the upper Midwest. We're challenged. I'm a private company, and I'm all of 3 or 4 people. I've got some great new colleagues, Mike Walsh, Rafael Marquez. We're a small group, and they can't give money to a for-profit small consulting advisory book. So we try to think creatively, and I call up Don Jacobs. And I say, Don, I have a problem. I think I can get a grant for $400 and $800, ultimately $1 million, but I can't do it. Is there any way you can help on financing this thing? And he said, sure, I'll make you a research professor, and we can get the foundation to give the money to Kellogg, and you'll, as a research professor, will be a faculty, and the university will allow me to do it. So we work together with the not-for-profit, the university, and I might say, Don, I said to Don candidly, and it's only at this great school, and with that great man, I said, I can't afford to pay 40% overhead. I need every dollar. He said, whoa. And he told me when he was retiring, and in this very building, he said, you know how to pay a lot of dues to get the overhead reduced. So he did that, and now we do the study.
So the feasibility study said, like, how much were you aiming at raising?
I was raising $1.2 million to do in effect, what would have been the business case for it. Could we attract people? Now, my wife reminds me, I generally start markets when the clouds are really heavy and dark, okay? And here it is. It's 2001. I'm doing the study. Gore loses the presidency. Bush takes over. Cheney, the environment is a dead issue. 9/11 occurs. We go into a deep recession, and I got an idea, and everybody thinks it's no good, okay? And so I go, and the study is completed. And now the question is, how do you recruit people? But more importantly, equally important, was how do you raise capital?
Right.
So I do a friends and family angel round. The key investor in the angel round comes to me, you grovel, right? You beg, you say to your family, help me out, do what you can. I get introduced to somebody, and he subsequently introduces me to the Jesuits at Santa Clara. And I meet Father Francis, and he says, we're really committed. Now, for those of you that go on to entrepreneurs, it's one thing for the pension fund of General Motors to lose money. It's the shareholders. For the Jesuits to lose money, their client, their owner, is a little different story. And so you really don't want to do it. And he gives you the bulk of the money, $1.5 million from the burial society, and I'm really all in at this point. I'm petrified. My secretary calls and says, Father Francis is on the phone. She's quaking, a religious woman, and she walks in, and I get on the phone, and I say, hello, Father. And he says, how are you, Richard? And then he says something you never want to hear a priest say. He says, how's your burn rate? I said, it's not good, Father. We're going through that cash a lot. This is not Then he says, are you assigning any new members? And I'm out at this point trying to convince key people to take a voluntary commitment to reduce carbon. And when there's no law, how in the world, why did they want to do that?
That's important, right? Because, a cap and trade system needs a cap. And at that point, there is no law, really.
There's no law. I've got Father Francis's $1 million. He's asking, are they joining? How many new members, Richard? None. Are you looking for any legislative help? No, Father. And then the conversation ends with, I pray for you every night, Richard. Okay? That's
also something you don't want to hear.
That's an unusual investor call, right? And ending with, I pray for you every night. It's not normally what your investors say to you. So we go out, and the key is to take Father Francis, and we get $50,000 and $100,000 pieces, and we're chewing through the money, but we're trying to convince people to take on a reduction when there is no law that says
that you should reduce.
That you reduce. So we develop a soft commitment letter. And this is a role model. And the soft commitment level says, Ford says, I agree to participate in the design phase of the Chicago Climate Exchange if the outcome of the design phase meets our corporate strategies and goals, we will join. So it's 2 sentences. It's only to get them to buy into the process. It was the frame of the painting, right? It was just to position the exchange in such a way. We termed something in the book, we called it was really an endowment effect, which you will know about, which you tend to value things you own more than abstractly you don't own. That's the nature of human behavior. So we had noticed, because we'd been in the exchange business for so many years, that there was a camaraderie around the exchanges. And I said, there's really more than just an endowment effect. There's something which we coined called the mutual endowment effect, that people like alumni of Kellogg, members of the New York Stock Exchange, members of the circuit, that if I could get a buy-in with these people to be part of the design and felt they had ownership for it, that we could make it a self-fulfilling prophecy.
I mean, this is a tricky period in a way, right? Because you're burning through cash to build this network of people that are willing to participate in a world in which there is no cap, as we said, but also there's not the same idea of corporate social responsibility that there is today, where companies feel compelled to answer to shareholders for pollution, for social issues, etc.
No, this is a Category 5, hurricane that I'm heading right into, flush into. No support. Washington doesn't want it. I've got a university that's sponsoring it. I line up an advisory group to make yourself bulletproof. When you're starting a new startup, you really have to have credibility. So I call up the mayor, Richie Daley, and I say, will you be chairman? I call up Don Kellogg. I call up the dean of Yale. I call up the Undersecretary General of the United Nations who organized Rio. And I call up the head of WRI. So I get a balanced portfolio of people who are willing to buy into the process. Then I go along with my team, and the team is critical because it's ultimately human capital. And I go to major opinion leaders, or my colleagues do, and we start saying, would you consider it? And we get some industry leaders. We get DuPont in chemicals. We get International Paper in forest products. We get the National Farmers Union in Dakota, because if you're going to want political support, go to the farmers. Always, because they have a very large megaphone into the world, and show the farmers that they can be part of a solution by reforestation, rangeland capital management. Then you're going to design a whole protocols, methane from animal waste and recapture that, all of these protocols. If we just flip the slide, the timing was right, because in the Kuznets curve, environmental spending goes up as development goes up. So the country now comes out of the recession. We're prosperous enough to be able to say to Ford, it won't cost you much money to go to American Electric Power and say you're 70% coal. This is not viable. DuPont, you can change how you make air conditioners. Let's have all 6 greenhouse gas in the program. Let's flip it one more time, because this is the key. And we're betting, while it's hard to read, at that time in 2000, somewhere
the top left.
The top left, we're at about 6 million tons. And it's a big baseline, but Europe has passed the bill to have cap and trade. Okay, so we're looking at the top left. We'll get to it later, but look at the bottom one, and you'll see the entire problem is China and India. China has more emissions today than the EU and the US combined.
Richard, can I ask you one thing in terms of convincing these companies to participate into this program at a time in which there is no regulatory cap that they have to abide by? So the fact that you managed to entice them to participate, is it because they realized that this was going to happen at some point, and so they better start with you before this market, from Europe that was already starting to come about? What was their push to participate, right? Because in principle, they have no incentive,
it's
right?
the perfect segue into the answer. If we could hit so we're in this design phase now. So we go to Ford, and your question is why? And Bill Ford is a young guy. His grandfather invented mass production. We say to him, look, Bill, you could set a standard. You've got 27 plants in the U.S., and he says, well, maybe I could bring in Canada and my Mexican facilities because we have plants in Dusseldorf, and the EU looks like it's moving ahead. So maybe I could join, and we could learn how to carbon account on figuring out the conversions between fossil fuels and carbon emissions, and it'd be a great way to learn, so I'm ahead of my competition in the European front.
I see.
DuPont says, I can make a lot of money here. Perfluoride, HFCs, the greenhouse gases you never hear about, are hundreds or thousands of times more potent. So if you can get the manufacturing companies, but also the chemical companies in the tech sector, where the multiples of 10,000, so 1 ton out of a smokestack versus 10,000 ton equivalent by changing how you etch chips, you really have a great incentive to do that. Okay, so we identify international, so DuPont's psychologically in. You go to international paper and say, you're the real winners. Okay, you make a lot of energy from pulp and paper, but you're in the sustainable forestry business. You change your harvesting practices, you can sequester a lot of carbon. So now we've gotten
some sellers and some buyers. Right?
And some sellers. And then you go to American Electric Power, and I'm on the board of Electric, so it's really tricky. I'm clearly conflicted. I have to send one of my team to it. One of their guys becomes a key leader. So we've now got forest products, manufacturing, chemicals, and utilities. And we come up with a document, and you can see we don't have legislation, but you need the equivalent of legislation. And like the French, there's always a value in naming. Phil Kotler would buy this argument in branding. So we call it the Chicago Accord. It's 17 pages. Unlike the Kyoto Protocol, we now have something to hang our hands on. A short document that says you're going to cut emissions. You've all agreed to do 1% a year. And the engagement is to make the legal process as cost-free as you can. So what you do ultimately is you develop a rule book, and the commitment letter says, I agree to join the Chicago Climate Exchange and abide by the attached rules and regulations. So the commitment level is short. It's like being a member of the New York Stock Exchange. And you get them in that. You now have regulatory issues.
Right. So at this point, you have, just to summarize, you have a set of potential market participants that are committed to decrease emissions by 1% per year, because they just decided that they're going to do it, just a self-imposed commitment.
And they won't, importantly, what you said summarizes something. Nobody wants to do it, so we have to get them to all hold hands and jump in the pool together. And we hold a press conference, and we announced Ford, American Electric Power, DuPont, an International Paper, and Manitoba Hydro are the founding members. We hire a PR firm. We asked the mayor to announce it in City Hall, so now everybody's all in. You know, you can't get out of that.
That's a commitment in front of the public, in front of the press.
You know,
You've done
you're done.
Yeah.
You know, you're now in. It's like the Roche Motel. You know, you get in, but you can't get out with that kind of public commitment. Now, the regulation is the rule book. We have a compliance committee. We have a committee that deals with you meet your reduction. We have a business conduct committee.
This is something actually I want to understand from you, because you create markets left and right, but there must be it's like a regulatory nightmare, no? Ask like the crypto guys, like anytime a new market comes around, it seems like regulation is sort of very hard to navigate. So exactly what do you have to do to say, I'm creating this new market of emission trading?
Yeah, you know, part of it is creating the institution. Right. Okay, so and writing the regulatory framework is part of the rule book. So the rule book is intangibly tied to the building of the exchange. So you have an exchange and you have an exchange rule book. Right? It's 120 pages and you can read about it in the book. You know, it's really some horror or in good derivatives. You have to get what is the penalty for not cutting and not buying credits. How do you penalize somebody? Anybody, any idea? What we do is have what I would term constructively ambiguous penalties.
Like with kids.
Like with kids. Yeah. Just that. You basically tell them, if you don't do this, we're going to penalize you. But the idea, if you put $1 on it, like $1,000, people will make an economic decision. If I can make more from violating the regulations, $1,200, I'll violate them. I pay $1,000 a day. So our rule book says, if you violate compliance, you will be put before the compliance committee, a jury of your peers, and they will assess damages to the thing. The level of damages will be uncertain and set by your peers at any amount they deem appropriate. That really scares people. Okay? Nobody likes not to know what the penalty might be. Okay, so you create this constructive ambiguity. But then you really say, oh, it's a club in Chicago, who cares? So you call up Mary Shapiro, who was the chairman of the SEC, before that the chairman of the CFTC. She heads NASD, which is the forerunner to FINRA, which audits all broker-dealers in the country. And you say, Mary, you'll never hear this again. I want to be regulated. Okay, and I will pay you to be the official regulator. I want you to go into Ford's Dearborn plant, get all of their fossil fuel expenditures, convert them to carbon equivalents, and you do a financial audit with the same robustness that you would audit Goldman Sachs. Now, as one of the chairmen and CEOs of a major company said, I'm never not going to comply, Richard. And I said, why? He said, because of what you did. And I said, what did I do? He said, I can't afford ever to be in the front page of the Wall Street Journal saying I'm being investigated by FINRA. Even if nobody cares who the CCX is, every stockholder knows who FINRA is. Yeah. And so you have a super policeman. So that's the regulatory side. Then the institution side.
Right. I mean, the market design, like how do you actually trade this thing? Like, what do they have to do to comply?
Okay, we're going to have to do part 2, but I'm going to try to set the stage for part 2, Carbon Hunters.
I also want to know how you make money out of all this.
So now we're going to get to that. So you recruit people. Now you're running out of money. Father Francis is calling. You got no money. You're dying. There's nothing left in the bank. So you call up and you get a hold of a friend. And one of your people introduces you to Rothschild. So you go to London. The Rothschild family is very famous for endangered species, stuff. So you hire them. You don't have any money. You tell them, I don't have any money. Like I said to Don, will you write the book? Please be gentle on the fees. You write it. Now you start making calls, and it's really ugly out there. Everybody tells you they love ESG. And when you say, can you give me $1 million? Well, maybe I don't love ESG so much. That's not the case. You run into a friend, and the friend says, let's go public. And I said, you can't go public, this is an idea, I can't. Well, yes, you can. You can register you in the Isle of Man as a corporation, and the Isle of Man Corporation will be the head of Climate Exchange PLC, and then you go to the AIM division, Alternative Investment Division of the London Stock Exchange, small caps, and we will raise capital there. And I said, well, how are you going to raise it? He said, well, what do you think it's worth? And can you flip the thing?
Valuation, guys.
So I say, okay, I haven't got a clue. There's no public exchanges at this point. It's 2002, and Merck hadn't gone public. ICE was non-existent. And so I take a look, and I did what I did with sulfur. Take a look at the wheat crop. See how many times wheat futures is the size of the crop. So if, in fact, the crop is 2 billion bushels, then the wheat futures would trade 30 times that, or 60 billion. And then you get a contract size, like 5,000 bushels. And then you put a $1 fee on the contract. So the joke was and in the book I had it, my young employees did the job great. And I had hired Frank Kenk, who's from here, to do compliance, and Cressy to do the legal. We needed a DCM, so we had to have money for that regulatory experience. And I hired Mike McGregor and Dan and Scarborough and a host of other, nobody over 30, okay, because they were blank minds and would accept everything. So we come out with the model, the front door, the back door, or the Sandor, okay? So the Sandor was to sell it as a crop. And that carbon as a crop was 30 million tons, and 30 million tons times 50 allowances. This could be bigger than the oil market based on the Sandor crop approach to valuation. And because it's the aim, all you need is project volume and rationalize. There's some nuances for all of you because an exchange has got 2 sources of data. So that 30 multiple is transaction fees. The other value proposition of exchange is selling the data, the price tape and things like that. So the traditional breakdown is 75% fee-based, 25% Bloomberg, AP, whoever else vends your prices. We go.
But sorry, Richard, in your projections, when were you thinking of sort of hitting the type of volume that, commodities were already hitting, in terms of, generating that type of cash?
Yeah, it was looked at as a 5-10 year
5-10
period.
years.
And in my experience, starting a new commodity is like a 20-year. I don't know why, but it's no different than the Apple computer till you got to the web, till you got to the iPhone. It seems to take a generation to have a new invention, whether it's industrial, financial, it doesn't really matter. So we go around and we do this crop, backdoor Sandor evaluation, and we stick a dart in it and say it's worth 60 million pounds based upon a financial 5-year table, discounted value. And we think you're going to be able to double or triple your money. We raise 50...
But at this point, sir, you're going on a roadshow on presenting the company, or not yet?
I'm going on a roadshow, but I'm going to a bunch of different characters than we thought. We're going to punters on the East End, and we go to one key guy who works for Invesco, and he made a fortune. The irony of it all is investing in tobacco stocks. But he's a rebel. And his wife is suffering medical problems, and he loves the idea because he enjoyed making money and being the best performing UK asset manager, but he didn't like the odor of it. So he decides to be the lead, and he'll take 29% of whatever we raise. So if we can only raise 10 million, he'll be 2.9 million. If we raise 1 million, he'll be 2.9. He throws in then more capital, which is Louis Bacon, a commodity trader. He got it. We couldn't get any institutional money, okay? With a new idea like this, you have to find non-traditional players. We raised it, and then when you are a first mover, all of a sudden, which we were positioning ourselves, the Brits announced they will do a pilot program, the EU, from 2005 to 2007. I am partners and on the board of ICE. I say to Jeff, I'd like to be a partner. We'll do a revenue share. You've got desktop real estate. Your machine is on every big energy trader. I think energy and emissions live in the same house. And I have a self-made distribution network. He says, great. We start the European Climate Exchange. We build the staff over there, and we grow the company. Now, the bottom line is we raised it at $1 a pound per share in 2003, and we sell it. We put it up for sale. We hire J.P. Morgan. It looks like the U.S. is not going to go along. The voluntary part of the business is not going well. We had started an exchange. ICE comes in, and I'm a happy guy because Father Francis is now going to get paid off. And we took it public at £1. We sold it at £7.50, so they made 7.5 times their money. And all was good. Father Francis was happy. The guy from Invesco was happy. We took the number of shares, we gave them to the Joyce Foundation. We funded a Jacobs lecture here in finance, so it was enough to do to give back to all of us that helped. So we created from $1.5 million from the Jesuits a $600 million enterprise value. That is now the leading exchange in the world. Its value. People say, well, you left money on the table, and we did, but, You never try to sell the highs?
Actually, I wanted to ask you your decision to sell to ICE, because as you said, you raise this angel money, you design the market, you do an additional effort to then go public in the London Stock Exchange, you find investors. At that point, you are trading in this sort of small cap part of the exchange, but you trade for about 3 years, I think, right? From
We trade 7 years.
7 years,
7
okay.
years.
Yeah. And then at some point you decide, we're going to sell to ICE. Like that, how did that decision come about? Like, why did you decide to do that?
Number one, I had too much of the family assets in the business. So like any entrepreneur, if it goes, my dream goes, and that would be no fun. In 2010, we had a Democratic president, 60 Democratic senators, and I thought the legislative outlook didn't look good. So in spite of all of the goodwill that the administration had, and they were very supportive, and Barack Obama was on the board of the foundation that supported it, the political tea leaves in America didn't look like we would get legislative breakthrough. And I said, if we got a president who's in favor of this and 60 Democrats, and it's getting caught up in politics, this will never work. And we started the Chinese exchange, and I thought that's where the world was going. The buyer was happy. If I look at the enterprise value, he paid $600 million. My guess is, based on his PE ratio, it's worth $3.5 billion. Wow. So I got out happily. Father Francis was really happy. That was key. The Joyce Foundation was happy. Northwestern was happy. My wife, Ellen, always tells me I stay at the party too late and too long. And I said, this party, it's time to go.
Time to go.
So I went
that makes a lot of sense.
on a note. There's a lot more to this. And the notion, and I want to go one last point, and I'll finish up because I know it's your time.
We want to leave a few minutes for the students to ask questions, but I have one more for you, and then you'll leave some time.
What's the golden opportunity? If any of you are in the business and want to be entrepreneurs, the Merck was nothing and traded pork bellies. It's got $100 billion market cap. ICE was a startup that was doing a look-alike natural gas. It's got an $85 billion. SIBO started with a couple of traders, and it's worth $25 billion. Right now, the market cap, or the price of Polymarket, which is a betting and prediction market, the DCM, the futures exchange, was $112 million, and Jeff Sprecher just bought 20% of the exchange for $2 billion. So it's a $9 billion market cap. Kraken just bought this small exchange for $100. These are 2025 transactions. This is live and happening right now. DraftKings just bought Railbird Exchange. When you lean over the rail at a racetrack, that's where it comes from. Railbirds is what they're called. And they're in a betting market. Quanta, which is the old team from CCX, started a new exchange, and now they're starting a futures exchange. So these things, we took 6 months to do it. We had the advice of people like Murali Kanakasabi, Nathan Clark, developing ag protocols, all of this stuff. But now, just the franchise for a futures market based on trades this year with zero business is worth $100 million. With what's going on now with betting markets and prediction markets.
So these are targets have no trading yet.
With no trading.
Okay.
So okay, just to give you an idea that the value, in my estimation, of a franchise with no business is $100 million. So I just want to conclude, because this is a Kellogg School of Management. This is just the beginning. We haven't talked about compute power. We haven't talked about voluntary markets. We haven't talked about prediction markets, hurricanes, tornadoes, earthquakes. We haven't talked about cat bonds.
I want to talk about China as well. But,
And China, if I had a baseline of 680 million at CCX, which was the size of Germany. Okay, we had $1 billion or $2 billion of baseline, 680 million. And to finish it off with China, if we can go back to those cubes. You tell me when China is 50% bigger than the combined EU emissions and US emissions, and they announced last week that they were going from intensity to absolute reductions. There's going to be some multi-billion, maybe tens of billions of dollars of environmental exchanges, prediction markets, etc. And
they just show the curve is starting to
flatten.
flatten.
And if you go to the Kuznets curve, it tells you this is peak emissions. And environmental concerns, it's one thing to worry about having food on the table and shelter. It's another thing to have wealth and to be locked in your shelter because the particulates are so bad that your 7-year-old girl is going to get lung disease. You switch your attention to public goods from private goods. I've thrown a lot at you.
That's great.
Go ahead, Don.
No, I want to leave like a few minutes because I think we have another 10-ish minutes. Yeah. And so I wanted to give some time for the students to actually jump in and ask questions if they have. So, yeah, floor is yours. Anyone wants to kick us off?
Come on, somebody. I know I've been teaching for 60 years. There's somebody that's got a question. Or did I answer everything?
You did answer everything. Good.
Thank you so much for coming and talking to us. I guess in light of recent events and increases in energy demand, even though we as an economy have transitioned down the Kuznets curve to a service economy, there's now a spike in demand for energy, which is being filled through carbon-intensive resources. Is that a trend that you think is likely to continue, or does that consolidate in some way in the future?
No, I think that your world is, I've never seen more opportunity in this world, given AI, given quantum computing, given the demand for power and energy, given the clean energy level. I think I kind of like this space now because there's nobody who thinks it's good. I mean, every characteristic in this country says that environmental objectives are not here. Energy demand is going through the roof. We don't have any plan. But as a contrarian, when everybody can't be right? And so I think that the data center demand is going to explode. If when I taught here 20 years ago in 2006 on carbon markets, if you would have ever said to me utilities are going to be a growth industry, I would have said you're crazy. But I think the whole infrastructure of the United States and the world, so energy, the environment, new financial products, that we're going to be looking, derivatives was hot. It's now, it's pretty routine. And it used to be the hottest academic field and the hottest intellectual field, and now it's yesterday. So I think all of you are at the dawn of a new era, and that new era is those trends are going to, the commodity adage, the trend is your friend. I don't think that is going to get interrupted in any way. So I think the opportunities are enormous. And you as young people, remember Gordie Howe's statement about hockey, you know, you got to skate where the puck is going, not where it's been. Okay, so it's going to a proliferation of new exchanges, new ideas, new products, as opposed to what you said at the outset. It's changing dramatically. You know, we're in a brave new world, and the opportunities, I think, are endless. And if you're running around and not every, but a hell of a number of kids out of Stanford and Silicon Valley are running around with 18 different cryptocurrencies and blockchains and prediction markets and starting exchanges at 23 years old, the human capital that's going into new financial products to deal with this new wave of intellectual products, which is what you said, Jacopo. It's no longer primary bulk agriculture and metals, right?
It's intangible.
It's intangibles, and that's the future.
And grading intangible, it's very hard, right?
Right,
and that's
it's
going to
hard.
be a big business probably, like especially in these emerging markets.
And I think that's your opening remark. The future of finance is intangible products. It's not what you think. It's not copper, right? It's something you didn't. You want to buy, and I can easily imagine now the deals are going on. You want to go to a data center. It costs $2 billion. Used to be you went to a shale gas and you drilled for gas and you did a 10-year gas swap. Now you want to buy compute power out 10 years. You want to buy carbon offsets out 10 years. So you're going to have financing that existed like drilling for oil or drilling for gas. You'll now have compute swaps where you're going to buy GPU. And right now, if you want to go Silicon Analytics, go on the website, and I'll tell you what's going on, and you go into a thing, a young woman started the business, you plug in a data center, plug in the chips, and they will tell you the exact carbon emissions for the next 10 years. That's out there now. People are starting businesses which give you a string of 20 years of carbon based on the chips you were using, and you can simulate it. So this is not tomorrow. It's
No, exactly.
It's today.
No, GPU futures, I mean, this is already being like, there's a market that is developing already, and of course, depreciation of that stuff is very complicated to think about.
And I just think it's a great time.